Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into a report from the Bank of Canada that suggests 60% of Canadian mortgage holders could face higher monthly payments by 2026. This is a significant finding, and it's essential for homeowners and potential buyers to be aware of these potential changes.
Yes, Steve, it's quite concerning. The report indicates that even though mortgage interest rates are expected to gradually decline, many borrowers will still see increases in their monthly payments when they renew their mortgages in 2025 and 2026. This is primarily because many current contracts were signed during periods of lower interest rates.
That's right, Janine. The Bank of Canada estimates that homeowners renewing in 2025 could see an average increase of 10% in their monthly payments compared to December 2024 levels. And in 2026, that increase is expected to moderate to around 6%. It's crucial for homeowners to plan ahead and understand how this might impact their financial situation.
Absolutely, Steve. It's important to note that the impact will vary depending on the type of mortgage. For instance, those with fixed-rate mortgages, especially 5-year terms, might experience the steepest jumps, ranging between 15 and 20% on average.
Exactly, Janine. Fixed-rate mortgage holders make up 40% of all mortgages in Canada, which is driving the overall upward pressure on renewal payments. However, for those with variable-rate mortgages that adjust monthly, payments are projected to decrease by 5 to 7%. It's a mixed bag depending on your mortgage type.
And it's not just about the numbers, Steve. This kind of financial pressure can be quite stressful for families. The Bank of Canada notes that borrowers facing payment increases at renewal are expected to see a sharper rise in their mortgage debt service ratio, the share of income spent on mortgage payments, compared to those with payment decreases.
That's an important point, Janine. For those with rising payments, the median mortgage debt service ratio is projected to climb from 15.3% in December 2024 to 18% by the end of 2026. In contrast, borrowers with decreasing payments will see their median ratio fall from 19.7% to 18.6%.
And let's not forget about the role of financial support. According to Mortgage Professionals Canada's survey, a large number of Canadians are relying on financial help to access homeownership. In fact, 70% of buyers in the past 2 years could not have purchased their home without some form of assistance.
That's a good observation, Janine. It's clear that in this volatile borrowing landscape, stability is a priority for many. The survey also highlights that 68% of those surveyed opted for fixed-rate mortgages, despite the potential for higher payments at renewal.
Yes. And it seems younger and variable rate borrowers are more likely to make additional or more frequent payments, which could be a strategy to manage their debt more effectively. It's about finding what works best for each individual situation.
Indeed, Janine. The Bank of Canada's analysis assumes borrowers maintain the same type of mortgage and amortization period at renewal, but there are options. Some may not experience changes if they proactively renegotiate terms or adjust their amortization schedules.
So, Steve, it looks like ultra-low mortgage rates are a thing of the past, at least according to recent insights from Canadian Mortgage Professional. They mentioned that despite hopes for an interest rate cut by the Bank of Canada, it seems unlikely due to rising inflation and a strong labor market.
That's right, Janine. The article highlights that variable rates are unlikely to decrease soon, and fixed rates are actually creeping higher. This is largely influenced by the 5-year Government of Canada bond yields, which have risen following recent tariff threats from the United States.
It's a bit concerning for those hoping for relief in their mortgage payments. As Alberta Central's chief economist Charles St. Arnaud pointed out, the low interest rate environment we've experienced in the past decade is not returning. This means Canadians will need to adjust their expectations moving forward.
Absolutely, Janine. The reality is that elevated rates are here to stay for the foreseeable future. The MNP Consumer Debt Index reflects this sentiment, with nearly two-thirds of Canadians indicating they need rates to fall to improve their financial situations.
And even though home prices have dipped in some major markets, affordability remains a challenge, especially for first-time buyers. As noted by Victor Tran, a Toronto-based mortgage broker, even slight increases in fixed rates could severely impact a buyer's ability to close a deal.
Yes, and Royal LePage has even adjusted its 2025 price growth expectations due to the sluggish housing market activity in the first half of the year. They project a 3.5% increase by the end of the fourth quarter, but this is tempered by buyer hesitation due to economic uncertainties.
It's clear that higher interest rates will keep a lid on home price growth, especially in expensive markets like Toronto and Vancouver. However, there might be room for appreciation in more affordable regions where the impact of high rates is less pronounced.
Exactly, Janine. As St. Arnaud pointed out, significant price gains will be challenging with sustained high rates, but there could be strong price increases in more affordable areas. It's a dynamic situation that requires careful navigation for both buyers and sellers.
And while there have been mild affordability gains recently, as Phil Soper from Royal LePage mentioned, these are fragile. Wage growth might be outpacing home price gains in some areas, but borrowing costs remain a concern for many Canadians.
It's a complex landscape, Janine. Navigating these changes will require strategic planning and perhaps a shift in expectations for many homeowners and prospective buyers. Staying informed and adaptable will be key as we move forward. Janine, it looks like we're seeing another wave of fixed mortgage rate increases, driven by a rebound in bond yields. This trend is largely due to stronger than expected economic data, both from the United States and Canada.
That's right, Steve. The U.S. Treasury yields have risen above 4% after their inflation data came in stronger than anticipated. This has had a ripple effect on Canadian bond yields, which closely follow their U.S. counterparts. It's a reminder of how interconnected our economies are.
Absolutely, Janine. Here in Canada, our own strong employment report for June has added to this upward momentum in bond yields, which are directly linked to fixed mortgage rates. Some lenders have already increased their rates by 5 to 10 basis points, and it looks like this trend could continue.
It's important for homeowners and potential buyers to be aware of these changes, Steve. Even though these hikes might seem small, they can significantly impact a family's monthly budget, especially if they're already stretching to make ends meet.
Indeed, Janine. Mortgage broker Dave Larocque has noted that while these increases reflect a short-term trend, they fit into a broader pattern of rising bond yields. It's a situation that could persist for a few months, especially with fiscal pressures from growing government deficits worldwide.
And as Ron Butler from Butler Mortgage pointed out, the broader fiscal pressures are indeed shaping these longer-term yield movements. He suggests that fixed rates in the 4% range might be here to stay for a bit, which could be challenging for those looking for lower rates.
That's a good point, Janine. And while inflation data suggests the Bank of Canada will likely hold its rate later this month, some, like Butler, foresee a potential cut later in the year. However, no cuts in July or September seem likely, which means those with variable rates will need to remain patient.
It's interesting, Steve, because despite these hikes, many fixed rates are still below their long-term averages. Dave Larocque mentioned that term premiums are starting to return, but many popular fixed terms are still priced similarly. This could be a silver lining for those needing to lock in a rate soon.
Yes, and Larocque also emphasized the potential benefits of variable rates in the long run, provided rate cuts happen as expected. But he cautions that borrowers need to be ready for volatility and possible higher payments if those cuts are delayed.
It's a complex decision, Steve. Those opting for variable rates must be prepared for the inherent volatility. As Larocque said, They need to have the financial capacity to handle potential higher costs if the forecast doesn't pan out as expected.
Exactly, Janine. It's a time for careful planning and consideration of one's financial capacity and risk tolerance. Staying informed will be crucial for homeowners and buyers navigating these changes.
Steve, the latest data from the Canadian Real Estate Association shows that Ontario home prices are starting to stabilize after months of decline. This is certainly a relief for many homeowners who were worried about the continuous drop in home values.
Definitely, Janine. The average price of a single-family home in Ontario fell from $944,400 in June 2024 to $880,700 last month, which is about a 6.7% dip. However, the fact that prices are stabilizing suggests that the market might be finding its footing again.
That's encouraging news, Steve. But it's important to note that while single-family home prices are stabilizing, condo prices in the province were down 8.6%, and townhouse prices fell by 7.8% over the same period. It appears the market conditions vary considerably depending on the type of property.
Right, and it's crucial to remember that these numbers are seasonally adjusted and do not account for inflation. Inflation rose by 1.9% nationally this month, adding another layer of complexity when evaluating the real estate market's trajectory.
And while the overall market seems to be stabilizing, there are still concerns looming. According to Sean Cathcart, a senior economist at the Canadian Real Estate Association, the recent 35% tariff threat from the United States could pose significant risks to the recovery.
Yes, Janine, the trade tensions with the United States have already cast a shadow over the real estate market. Although we've seen a rebound in sales activity in places like the Greater Toronto Area, we are not entirely out of the woods yet, especially if these tariff threats materialize.
It's a delicate situation, Steve. Valerie Paquin, the chair of the Canadian Real Estate Association, mentioned that if the spring market was held back by economic uncertainty, any further shocks could delay the recovery even more. But she also suggested that delayed activity might surface this summer and into the fall if conditions stabilize.
That's a valid point, Janine. The northern parts of Ontario, like Sault Ste. Marie and Sudbury, are already showing stronger growth compared to other regions in the province. It indicates a potential for recovery if economic conditions improve.
Yes, Steve, and it's heartening to see areas like Sault Ste. Marie experiencing a 4.9% increase in single-family home prices year over year, with Sudbury seeing a 7.4% rise. It gives hope to homeowners in these regions.
Absolutely, Janine. While it's a mixed bag across the province, the signs of stabilization and growth in certain areas are promising. However, as always, it's essential for buyers and sellers to stay informed and be prepared for any economic shifts that may occur.
Well, that wraps up our discussion for today, Steve. It's been insightful to explore the current state of Ontario's real estate market and the factors influencing it. As always, staying informed and prepared is key.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.